Good morning, everyone, and welcome to today's webinar on non-QM niches. We're very excited to have you guys here. We want this to be as engaging for you as possible. So as questions come up, please go ahead and use the questions tab, and I will ask the speakers on your behalf. We'll also have some extra time at the end to talk about, answer any additional questions. With that, I will turn it over to today's speakers. Take it away, Tanner.
Hey guys, Tanner Williams, regional manager here. I've been with the company about 4 years now, and excited to talk to you guys today about some niche products.
My name's Weston. I report directly to Tanner Williams. He's one of the best in the industry as far as getting exceptions is concerned, and so that's why he was asked, and he asked me to come along with him. So we'll have a great time learning about some of the stuff that LendSure can do. We're pretty outside the box when it comes to certain things that I'm really excited that we'll have the opportunity to talk about today.
So first, just a little bit of background on us. We were founded in 2015, but our management team has roots, dating back much longer. Very experienced management team that knows credit, knows a good loan when they see one, and we have a partnered investor that knows that and trusts them. And so, when they say, hey, we want to lean forward, we want to do this loan, we think it makes sense, we're able to ultimately sell it to our partnered investor. And so, those two things combined allow us to do a lot more than, what your typical average non-QM lender can do. So that's really the root of, why we're able to offer the things that we're going to talk about today. Let's see if I can take over advancing the slides here. There we go. So the first thing I want to make sure we're clear on is the difference between, what's a guideline, what's an exception. So the context in which we're talking about a lot of the things today, we'll say, oh, we can do, or we have the ability to, et cetera. But it's very, very case by case, right? It's very, what's the situation? Does it make sense? We do these at a very high rate. We're very good, at closing these, but we won't do all of them. We won't do every single one, right? So it really is just going to depend. And one thing that we'll talk about towards the end of the call is our pre-approval process and how thorough we are, to what level we actually escalate files within the first 48 to 72 hours to give you that solid answer. We're kind of playing in the gray, right? And living in the middle, we want to be sure that we're not pulling the rug out from anybody, right? And so, a lot of the stuff we'll talk about today is exception based, but we do it very consistently and very well, and we kind of know what we want to look for, right? So,
Can you advance the slide for me, Tanner?
I'm trying to. Here we go.
No.
Career
Perfect.
professional.
Thank you. Yeah, so career professional, kind of going along with that, you've probably, if you guys have worked with LendSure before, it's most likely that you've heard one of your account executives talk about our career professional program, right? Kind of going back to what Tanner was saying, this isn't technically a program. This is an exception, a very common exception that we make for borrowers who are less than 2 years or even less than 1 year self-employed. So digging into a little bit of that. If you haven't ever done any non-QM before, this is probably what you will run into quite frequently, is people who recently switched from W-2 to 1099, or maybe they recently acquired a business that they currently own. The idea behind our less than 1 year, our career professional program, is that borrowers are doing or are in a similar line of work to what they were doing before, but they just recently switched income types, right? So as mentioned in our career professional program, the most, like I said, there aren't any hard and fast guidelines. Each borrower is going to be different, but to give you kind of a general idea of where we are with LTVs and FICOs, it's pretty standard that 85 is the max that we can approve for someone who's just switched to self-employed, and then 680 is usually the bottom limit of what we do for FICOs, although we have gone below that But the key really to focus in on with the less than 1 year self-employed is this a common sense, make sense loan? So let's say, for example, you know, we're going to be taking into account work history, what the borrowers did before they became self-employed. Were they doing the same line of work as they were before? If let's say, for example, you know, they were just to qualify off of W-2 income, would they be able to qualify off their previous W-2 income, or are we going to have to give them significantly more income based off of what they've earned since they've become self-employed? Are they a first-time home buyer? What does the pay shock look like? Are there strong reserves? All of these things are going to basically determine how aggressive we are on LTV, how aggressive we are on FICO, just basically talking about the overall strength of the borrower. So as I mentioned, you know, compensating factors are going to be key for getting this done. If the borrower is clean on paper, except they just recently switched incomes, then we're going to be a lot more aggressive. But if they have bad FICO and the business that they're running now is maybe not earning as much money as they were when they were W-2, then we're probably going to have to pull back the LTVs. So
yeah, the prior W-2 income one is one that I see a lot of confusion on, Weston, and so that's why I want to kind of speak to that a little bit more. You're absolutely right that you know, if somebody is able to qualify off their prior W-2 income, it certainly helps us and serves as a compensating factor, right? But it's not a requirement, right? It's just one of those things where, oh, you know, you've been self-employed for a year. Well, what happens if this whole self-employed thing doesn't work out? I'm probably going to go back to being a W-2 like I was, you know, prior to, you know, attempting to go self-employed. And so if I know the mortgage is going to get paid, whether the self-employed thing works out or he goes back to being W-2, it certainly serves as that comp factor.
Weston, I have a question.
Yeah.
Jackie wants to know, so you qualify on 12 months bank statement, 24 plus W-2? How does that work?
Awesome question. So again, it depends on the nature of the industry. And actually, if you advance the slide to the next one, we'll actually speak to the amount of bank statements that you would need depending on what the scenario is. In all cases with this less than 1 year self-employed, the key is to contact your account executive because they've been trained and they will know exactly how many bank statements that you will need for any given scenario, right? So below we have 5 main cases to consider as far as number of bank statements that you would need in order to qualify. So the most aggressive that we would ever be is as little as 1 bank statement, right? 1 month of bank statement. And in the case when we're only wanting 1 month of bank statements, that's when they were a W-2 working at the same facility that they were before, but then they switched over to 1099 and they have contract minimums, right? Basically saying, hey, you were a nurse here, you were a W-2 nurse, and now you're switched over to 1099. We're still going to contract you for 40 hours a week, paying you X amount of dollars, right? And we can see that it's similar to what they were making as W-2, right? So now they're just 1099, but they have a contract with the hospital, the same hospital that they were working with, and basically guaranteeing them pay. It's not quite as good as W-2, but it's almost as good as W-2. So, you know, the type of people that we see for that are doctors, dentists, CRNAs, software engineers, people who were previously working for the same company, or maybe they were even working for a different company, but got contracted over to work with a different company, and they have contract guaranteed minimums, right? So that's what we're qualifying for, as little as 1 month of bank statements, right? The next, you know, there's levels of aggressive-ness to this. So the next one where we would be a little bit more cautious is if you were bought into an existing business. Common examples here are lawyers, doctors, or dentists. An example of one that I closed last month, there was a lady who was a manager at a consignment store, and she had 7 months as an owner of this store. So she was a senior manager. She had managed the company, and the owners of it sold it to her. She became a 50% owner of it. we were able to qualify off of the income that she had been making as a 50% owner of this consignment shop that she was previously a manager of. So similar thing with a lawyer or a doctor or a dentist. They are, they work for the practice, and then they buy in, they become a partial owner of the practice. Those people were going to want a little bit more income just to make sure that basically the trajectory of the business has been more or less the same since they've become managing partners of the business. Purchase an existing business, 3 to 6 months. Tanner, do you have anything that you want to add for this section here?
Yeah, so the analogy I like to use on it is, is your borrower jumping onto a sinking ship or a rocket ship, right? Because a lot of the times when a business is being sold, it's being sold because it's not doing too hot. And, someone will come in and look at the business and go, well, it's got good bones, it's poorly managed, I just need to come in and fix some things and turn it around. And that's a situation where we're going to want much closer to 12 months to see, okay, prove to me you've turned it around, right? But in the case of a rocket ship, right, a lawyer buying into 25% ownership of a practice that's been around for 15 years, they're doing great, making a lot of money, looking to grow, looking to expand, et cetera, right? That's a situation where we're going to look at the last 2 years of business tax returns. We're going to look at maybe year-to-date bank statements and see, okay, yeah, since our guy, came into partial ownership, he hasn't really rocked the boat. Nothing's changed. They're still making money. They're still on an upward trajectory, right? So again, it's just going to come down to how confident we can feel that the income is going to continue, and that this is legitimate. It's going to be able to pay our mortgage, right? All that stuff. So very case by case. That I would say bullet 2 and 3, the buying into a business and purchasing a business outright, are probably the most difficult of all the less than 1 year self-employed we do. Bullets 1, 4, and 5 a little bit easier.
Yeah. And then the final 2 ones, this is just kind of like a catch-all, is a 1099 with no contract or no guarantees, and also starting a business from scratch. Both of these, basically your income isn't guaranteed to you, and so we're going to want to see as close to 12 months as we can, but we have been able to close with 10 or 11 months of income as a newly self-employed individual with no prior history equal, or that was in the same line. And so as a result, we're going to want to see pretty close to 12 months. So basically, to sum everything up, how confident we are that the income is going to continue moving forward is going to depend on what their income has looked like looking backwards. And we're basically to make sure that, hey, this is something that we feel confident that they have been making and that they will continue to make in the future. As far as started a business from scratch, the most recent one that I closed, we had a borrower with a donut shop that they owned in California that then moved to Arizona and started a new donut shop, right? So they started a completely different company, and we got 10 months of business statements for them. And we were basically able to qualify off of the 10 months of statements. We divided that by 12 and treated it almost like a 12-month bank statement loan. So as far as pricing is concerned, for these sort of loans, most of the time we're pricing them as 12-month bank statements plus, additional deviation pricing because of the exceptions that we're making for less than 1 year of self-employment history. So, this is a loan that we do very frequently. This is a loan that I personally am comfortable with, that we've done. And again, I would just preface it with, or conclude with, if you ever have a scenario like this, call up your account executive and they will be able to tell you and give you instructions on whether or not this is something within our wheelhouse or not.
Yeah, you guys will hear us referring to compensating factors quite a bit throughout the course of this presentation, and this one probably more so than anything else we're going to talk about. I mean, if you have somebody, that maybe is just falling short of the months you see on screen, but they're putting like 40% down, I'm going to want to consider that loan, right? Now, if they're putting 15% down, I'm going to be like, maybe you're getting out a little, over your skis here, and you need to make some money, for a little while longer here, save up, get more months under your belt, right? But there's going to be certain situations where we just go, this is a no-brainer. It makes sense. This guy's got cash, he's got a great FICO, et cetera. We're going to want to lean forward on this. So Just like with everything else we do, I wouldn't take anything, at face value that you see on these slides as like, oh, well, that's the requirement or else I'm toast. It's going to depend on your scenario.
Guys, I've got several questions about the recording and slide deck. Yes, this is being recorded, and yes, I'm going to send you guys a link to the slide deck so you don't have to worry about writing stuff down and taking notes. Look for an email from me, Rose Waldy, about an hour after the webinar ends, and that's going to have the recording, it's going to have the slide deck, and a couple of other really great resources for you guys. I have a question from Connor. Do you all get scenarios from the link movement uses to send scenarios to the wholesale side?
Make sure I understand that question correctly. He's talking about movement mortgage?
Yeah, he's using a capital M in movement, so I think it's a company.
Okay, got it. So he's saying with like when he submits something up to his scenario desk. I think it does go to us. I would say that you should still familiarize yourself with who your account executive is and reach out to them directly, because I think it goes to like one account executive over here that manages the movement relationship rather than developing a personal relationship with your agent.
Okay, and then forgive me if I get this wrong, but Sakia wants to know, for newly self-employed, are you willing to make exceptions for the legal residency status? I have a couple of potential borrowers with good credit and income, but they are here on asylum.
Yeah, that's a good question. So in the last, call it 8 months, six to 8 months, we've moved away from granting exceptions on visa types for non-permanent resident aliens. So if it's going to be a non-permanent resident, we do have to adhere to, what our guidelines say on that. So any C-class visa would be out, which is mostly the asylum ones. If it's, like an E1 or E2 or an L1 or something like that, we can certainly look at it. But I'd say just reach out to your account executive and say, hey, these are the classes the visa classifications my borrowers have. Is it something that's in your guidelines? That is one area that I hope to get back to granting exceptions on, but it's largely influenced by the political climate and the current administration and stuff like that.
Okay.
Okay, so let's go on here to the next slide. Oops.
Sorry, guys. There you go. All right, I'm not going to do it. You do it, Tanner.
Okay, I got it. All right, DSCR loans for first-time home buyers. So DSCR, if you don't know what DSCR is, it's also called investor cash flow. It's really a loan that is supposed to simplify buying investment properties. We're just looking at the subject property's rental income versus the the mortgage payment, essentially. So DSCR has traditionally and still is pretty much reserved for borrowers that are either experienced investors or own their primary. And the reason is occupancy concerns. So, we are able to overcome those occupancy concerns when we really understand what's going on. So, a lot of the questions we're going to ask, are they buying the subject property in the same city/state they currently live? Where do they physically work, or are they remote? Does it make sense to buy an investment property here instead of a primary? So, one that really sticks out to me is, okay, I, live in downtown LA. It's my spouse, and our 4 kids under the age of 18. And for us to buy a primary, to accommodate that, size of a family in LA, we're looking at $2 million plus on purchase price. So does it make sense to, buy an investment instead of a primary there? Yeah, maybe. they may not have the funds to be able, or the income to be able to handle, a $2 million purchase. But, instead of putting 50 grand or 100 grand into the stock market, maybe they say, oh, I want to put it into buying a condo as an investment property. And, it's a 1-bed, 1-bath condo. Am I going to move my wife and 4 kids into a 1-bed, 1-bath condo? Probably not, right? So, does it make sense that they're buying an investment instead of a primary? Do they already own other investments, right? Maybe they don't own a primary, but they have, an experienced investment portfolio. And then does the subject property cash flow, right? So if I'm buying a house and my intention there is to use it as a vehicle to, make money, and they're asking for negative ratio DSCR, or we need to put down 40% in order for it to cash flow. It's like, that's probably not a very good choice for an investment property. It raises red flags about what your intentions really are with that property, right? So those are some of the preliminary questions that we ask. Other challenges we're going to face: can they document they pay rent? Can they prove it? Not private party VOR type stuff, but hey, here's 12 months of bank statements showing my rent coming out every month, or 12 months canceled checks, something like that. How deep is credit? A lot of times, we're looking at first-time home buyers. They don't have mortgage experience. Maybe they got like 1 or 2 credit cards, and one's an authorized user, so it's not even really their card. The FICO being like 740 or 760 is all fine and well, but if they don't have deep credit, then it's not as strong as if they do. Can they put down anywhere between 30 and 40%, depending on their situation, right? So we're definitely not gonna be doing 20 or even 25 for somebody in this boat. We're gonna say we gotta hedge our risk a little bit here and have them put a little more down. Do they have good reserves, right? Okay, well, I can put the 30% down, but then I'm not gonna have any reserves. Well, I need you to have 6 months, right? So, that can be in the form of retirement. It can be in the form of even crypto. So, we have some options there, and we'll get to crypto in just a bit. And then will they accept the pricing, right? So we're not going to do this at your standard typical DSCR rates, considering most lenders aren't going to give them financing. So we know this is a riskier loan. We're going to grant the exception, but we're going to require that we price up a little bit to handle that risk. And so is that something the borrower is even willing to tolerate? So those are the primary factors we're looking at when looking at first-time homebuyer DSCR.
Hey, Tanner, I've got a question from Toby. He wants to know, will you do an 8-unit for first-time homebuyer DSCR?
That's a good question. So we do have 5 to 10 units. We will talk about them later in this presentation. That is going to be a much more difficult exception to approve than 4 units or less. We're all gonna, we're gonna have the same questions regarding occupancy, the same questions, regarding whether this makes sense or not. But we're probably going to be much closer to 40 to 50% down if we were to entertain something like that. I would say that normally, getting a first-time investor exception for 5 to 10s, right? Not first-time home buyer, but first-time investor exception to 5 to 10s is something we can overcome. First-time home buyer would be leagues more difficult, but if they have cash and it makes sense why they aren't wanting to buy a primary, then we can look at it.
But in my experience, the answer has usually been the more money the borrower has, the faster the problem goes away. And I guess that probably kind of speaks to this crypto slide that we're going to be going through. Cryptocurrency, we get a lot of requests for this. This is one of our more popular products. And so we're going to go through and talk about how we go about using crypto, what we can use it for, and what are some of the key things kind of to watch out for when using crypto. So first is using crypto as assets for down payment. The biggest issue that we run into with people who are looking to use cryptocurrency for anything, for assets, for reserves, for down payments, or for income, is just being able to source it as theirs. If they have their crypto in an account like Robinhood or Coinbase or Kraken or something like that, a statement that we can print out that has their name on it, that has an account number associated with it, that is the best case scenario, easiest way. I had a scenario the other day where the borrower was short assets for reserves, and I was like, do you have anything else? He's like, well, we have a Robinhood account with $150,000 worth of crypto, Bitcoin. Is that going to work? Absolutely, right? We can clearly see, hey, they have their name on the statement there, and we can easily source it with them. Where things get a little bit more difficult is if they have their wallet, if they have like a crypto wallet not connected with the internet, right? They just have it. Sometimes they have it in like a ring, or sometimes they'll have it in a card, or basically some sort of external hard drive that's holding on to their cryptocurrency. That is a little bit more difficult for us to verify, but not impossible. so far what we have been doing in the scenarios where the borrowers do not have an account, but rather they have a crypto wallet, is we've been doing something like a Satoshi test, where basically we say, okay, within the next hour, deposit $1.23 into this account, right? And that basically lets us know that, hey, they have access to and they have control of this account. This is something that we are going to be able to wire funds from at escrow come the time of closing. As it mentions there in the slide, the worst case scenario is that maybe the assets aren't our borrowers, and they're being given to them as a gift, and in which case we would follow gift guidelines, which requires a minimum of 20% down, and then we can get into the nitty gritty there, but basically the easier it is for us to document that the assets are the borrowers or the crypto is indeed our borrowers, the easier the loan is going to be. If we're having a hard time identifying that the crypto belongs to our borrower, then we're probably going to need, again, lower LTVs. It doesn't mean we're not going to do the loan. It just means we're probably going to have to lower the LTV. So crypto for assets as down payment is good. We can do that. We have done that in the past, and we will continue to be doing that in the future.
Yeah, I want to give a quick example just again of proving control over an account, proving, or maybe not proving, but strong indicators that our borrower is the owner of an account. Had a request for a borrower that bought a home in cash for $7 million, liquidating the cash to close from their crypto account. And so, they wanted to do a cash out refi, get 3.5 back. And I think to myself, I go, okay, so worst case scenario, someone else gave them $7 million. How likely is that? Probably not very likely, right? So, just the fact that they pulled $7 million from this account at all to buy this house in cash makes me pretty confident that it's their account, and, giving them 3.5 back and then depleting from the crypto that's left over in that account, which we'll get to in just a second, is something that we were, looking at for this borrower. But again, it's just about how confident are we that we can, demonstrate and feel good that this is our borrower's assets.
Tanner, Brian has a question. So there's no sourcing of the income in the crypto accounts?
So it's a good question. I mean, if the crypto account had $1 million in it, 35 days ago, and now it's got $2 million in it, then we're going to be like, yeah, where'd that million come from, right? But when it comes to, the sourcing question is a difficult one, right? Because your traditional lenders and banks and stuff will be like, well, I need a statement. And it's like, well, there is no statement. He transferred the money in from his wallet, right? And so, we have to do what we can and just make a best effort to like I said, demonstrate ownership, demonstrate control. And to Weston's point, LTV is kind of going to fix a lot of, situations, but it's not like we're going to see, several hundred thousand or $1 million showed up in this account within the last 30 days, and we're just going to ignore it. We're going to say, okay, what wallet did that come from? Let's see what that wallet's balance was, prior to and now after that transfer, and do everything we can to tie it all together.
Yeah, and then kind of going back to the scenario that I mentioned before, crypto as reserves. This is also a very common one. Obviously, whenever you come across a borrower with a lot of cryptocurrency, their goal is they don't use, unless it's going for the down payment, they don't want to have to liquidate anything. Otherwise, they're going to have to pay capital gains tax, and I totally understand that. And so, as a result, we can use crypto, unliquidated crypto, as reserves. Again, similar thing. We're just going to have to verify, make sure, at least do our best to verify that the borrower, these are their assets. And similar to a retirement account where you would, use 80% of the funds towards their reserve requirement, it's the same thing with crypto. We're going to put a 20% haircut on that, just to, account for the fact that they probably would not liquidate it otherwise. So cryptocurrency for down payment and for reserves, we have done that, and we will continue to do that. And then where it gets a little bit interesting is we can actually use cryptocurrency for their income as well.
So cryptocurrency is income doing, asset depletion. So if you're not familiar with asset depletion, which I think most will be because Fannie and Freddie technically do asset depletion from like 240 and 360 month draw schedules. Our typical draw schedule for asset depletion is 120 months. So you take their crypto and divide it by 120 months. Now, just like there's adjustments for certain account types. So like, for example, a borrower that's not of retirement age that has money in an IRA, in order for them to pull that money, there's going to be penalties for that. So we adjust that account balance down to 70% before we do our asset depletion calculation. Similar thing here on crypto, we're going to adjust by 50% just due to the volatility of that asset type and the fact that it can swing so wildly in a short amount of time. We're going to adjust for 50% of the balance, then divide by 120 months to get our income figure and what we're going to use. Now, we still calculate a DTI, right? We still need to understand what's on credit. We still need to, figure out REO schedule, what's their rental income, what's their loss, et cetera. But, as far as their income goes, if they have a job, great, we can combine it with asset depletion from crypto. And if they have other assets like, stocks and bonds and things like that, we can also deplete from that. So, it doesn't have to be a one or the other. We can combine. And, a lot of times the crypto is really just pushing us over the edge. Sometimes it's really the primary source of the income and the borrower's just got, tons of money in crypto. But many times we're looking at, our DTI is 55%. It's just a little bit over. Oh, but they have, 250 grand in a crypto wallet. And so we're going to deplete from that and get us, fixed on the DTI. But, this is something that, to my knowledge, nobody else is really doing. So again, just another unique program that we have and something we can do to help your borrowers qualify.
Tanner, John wants to know, crypto may be used on all non-QM products, primary, second, and investment?
It's a good question. So as far as reserves, yes. As far as income, we actually don't asset deplete on investment loans. The approach we take with it is, obviously DSCR first. That's easiest. If it cash flows, great. If it doesn't, we can look at negative cash flow. We can even look at no ratio. And then if we do go to look at income on investment properties, which we can do, we'll look at a borrower's, income, their job, whether that's bank statements or W-2 or whatever it is. But if even that's not enough to qualify, and you're talking about going one step further and saying it doesn't cash flow and we don't qualify with their, business income, we need to use depletion. And then even depletion from crypto, it's like you're really reaching for what you're trying to buy on this investment property. If you put a little bit more down, probably ratios, and you probably just do get away with DSCR, right? So technically, this, crypto, as well as just asset depletion in general, we don't really do on investment properties.
And Ben wants to know, so you adjust crypto balance by 20% or 80%?
So yeah, go ahead, Weston.
Yeah, so 20% for reserves, just because the idea is if you were to liquidate the crypto immediately, you would pay, however much that is, you'd have to pay for capital gains tax. But then we do 50% for asset depletion income because of the volatility of that asset class. So if you're looking to use the assets for income, it's a 50% haircut. And if you're looking for asset cryptocurrency as reserves, then it's a 20% haircut.
Yeah, and let me be clear on that. So if I have $1 million in crypto, we're using 800,000 for reserves, right? So just like stocks and bonds is an 80%, right? Same type of thing. If I liquidate, stocks, I have capital gains on that liquidated stocks, and that's why we adjust. So if I have $1 million in stocks, I do 80% for reserves. If I have $1 million in crypto, I'm using 80% for reserves.
Okay. And Carlos wants to know, so basically crypto is only for down payment for investment property, not primary, right?
No, you can do crypto for down payment as primary, yeah. Yeah, you just can't use crypto as income for an investment, but you can use it for down payment or reserves on anything.
Okay. And Israel wants to know, is it possible to do a DSCR for a multi-unit where the borrower resides in one of the units?
The answer is no. We can look at using income and qualifying them, using income, as a primary residence and give credit for rental income from the other units, but you can't do DSCR if they reside in one of the units.
Okay.
All right, cannabis income. So my understanding of cannabis income from a conforming perspective is you guys can do it Fannie Freddie, if they're a W-2, but if they're self-employed, then you're out of luck. And so we allow it for W-2s as well, but primarily when we're talking about using cannabis income, we're talking about it in the context of self-employed individuals, because we'll do that as well. So we do cap LTVs a little bit lower than normal. Now, that said, I have gotten exceptions to go up above these LTVs, especially when looking at 85 for purchase and 80 for rate and term. For cash out, we'd probably still hold at 75. The minimum FICO there for full doc, self-employed, or 24 months bank statement self-employed. Again, another guideline that we're able to make exceptions on and go below. So, across the board, when people ask me, oh, hey, can you send me your guidelines? Or, hey, can you send me this? Can you send me that? I send them, but I'm like, with a grain of salt, hey, these are more like suggestions than they are guidelines, right? Just with how many exceptions we make. So I don't want you to look at something and say, oh, well, it looks like LendSure can't do it, and then they don't call the account executive, because the account executive is going to be the one who can most accurately tell them if we're going to hold strong to that guideline or if there's some wiggle room there. I think the data on it is we grant exceptions on about 40% of our loans, and I think industry standard is sub 10%. So it's a pretty wide gap on what we're willing to do. As far as cannabis goes, we typically are only looking at owner occupied, and we want to stay away from anything rural or multifamily. So the primary concern there is growing product on the property. We're going to be very certain that that's not the intention and that's not the case. Now, we've been able to make some exceptions to this, again, when we can feel comfortable that that's not what they're going to be doing. But we're looking for a good amount of reserves, 12 months reserves, and it to be legal in the state the business is operating. So I'll give you an example. Closed one earlier this year, actually two. Borrower was buying a property in Texas. In Texas, cannabis sales are not legal, either medically or recreationally, but their business was based out of New Mexico. And in New Mexico, it is legal recreationally. So essentially all we had to do is what you would do anytime a borrower is moving states and as a business owner is just demonstrate that they're able to operate their business remotely. So they have managers in place and a structure to their business such that they don't need to physically be there in order for the business to flourish. And once we proved that, then we were all good to go. So it's not about where the subject property is, it's about where the business is, the business operating legally. And that can be in a state where it's not legally, legal for recreation. So take Utah, for example, only medically legal if you have a business and you are distributing cannabis in a strictly legal medical way, then we can use income from that business towards qualifying as well.
I've got a question from Jeanette. It says owner occupied only. Can it be a multi-unit property?
Typically owner occupied only. Multifamily is not supposed to be allowed. Again, the concern is growing product in the other units, right? Not the one you live in, but the other ones. So it's something that can be overcome with the proper vetting, with understanding, the borrower's business and their role within the business. Something that's at a large scale, like, oh, I have, 15 locations and I have these large, cannabis fields in Oregon or in California, where it's like it's like a whole operation. Like, I'm not a mom and pop. I'm not going to be growing product in my house, right? Then we can get past it a little bit easier than if it's just a small time operation and there might be some concerns there.
Okay.
Yeah, that, or if you're like trying to say do a cash out refi on a duplex and you can show that there are tenants like in the other unit, then that also kind of gets rid of that issue. So
exactly, good call out. Okay, so full doc. is not something we typically talk about as a non-QM lender, but in the spirit of this presentation and understanding, what we do differently, there are a lot of loans that we close that are full doc loans that are with us for no other reason than we are going to look at the income a little bit more aggressively, a little bit differently. So, sometimes you may have a borrower and you think to yourself, oh, well, he's W-2, so bank statement loan doesn't work. It's a primary, so DSCR loan doesn't work. It's not a non-QM deal. I'm not even going to call my account executive. And that's not necessarily the case. And so we'll talk about some of these topics here on where we can kind of fill in some gaps in what Fannie Freddie will allow. So the first is 1099 only. So you got a borrower that is self-employed. They get a 1099, but they still have a bunch of write-offs showing on their tax returns. And for whatever reason, their bank statements won't work either. So some common examples may be, I don't deposit all of my checks into my bank account. I take some and cash them directly and spend the cash. Or I have my mom on my bank statements with me and she's not willing or able to go on the loan with me. And so that's a problem because she's technically, a joint owner of this personal bank account. So what we can do in those cases is we can say, hey, we're going to look at the 1099s by themselves. We're not going to look at the full tax returns and see the write-offs. We're just going to be looking at the 1099s and we're going to go full doc 1099 only. Another one is avoiding schedulees. So you have a W-2 borrower, he owns 10 properties. He's got all kinds of depreciation and maintenance and write-offs and stuff on his schedulees that are just killing his ratios. And you may think, well, he's buying a primary here. Again, can't do DSCR, can't do bank statements. What do I do? Well, what we do is we actually avoid looking at the schedulees altogether. We say instead, I want to see your lease agreements and then 2 months of bank statements proving those leases are being collected. And we're not even going to collect your tax returns or look at your schedulees. We're just going to look at the leases and then 2 months of bank statements. Using W-2s for those that earn a lot in cash tips. So very common example, I close a lot of loans down in Las Vegas. You got bartenders, waitresses, bellhops, slot machine attendants, valets, taxi drivers. You got all kinds of people living in a cash world down there. And so their W-2s will show they've made some money, right? 20 grand, 30 grand, 40 grand, whatever it is. But then they got another 10, 20, 30 in cash that they're taking home and depositing into their bank account and not reporting and not showing on their W-2s. So we're using their W-2s and we're looking at their base income, but then we're also looking at their cash deposit income in their bank statements as well. Closing in an LLC or a corporation, especially with a reverse 1031 exchange. We have a whole webinar on reverse 1031 exchanges that is phenomenal if you guys want to go watch that. But essentially it's, I got a full doc borrower, but they want to close in an entity and Fannie Freddie won't close in an entity. We will, there's certain situations where that's a requirement because a lot of loan officers will say, oh, we'll just close in their personal name and we'll move it into the entity after the fact. And that's all fine and well, unless you're doing like a 1031 exchange where the property they just sold was vested in their LLC. You now have to close in the LLC on the new purchase for tax reasons. So if you have to close in that LLC directly, then you got to go with a non-QM loan. No seasoning requirement for cash out refinances. So whether it's, oh, they did a cash out refinance 3 months ago and now they want to pull cash out again because they only pulled out like 100 grand and their home's worth 750. Fannie Freddie won't let you do cash out refinances so quickly. Could also be a situation where you just bought a home and you want to do a cash out refinance on it because you bought it in cash and they say, oh, you got to wait 6 months. We aren't going to require that either. So just some of these waiting periods, some of these seasoning periods we can get around in a lot of cases. We can even consider it in situations where, I just had this come up last week. Borrower lived in a home with his mom. His mom was the only one on title, but he had been making the mortgage payments, right, for the last year. And so, we did a cash out refinance for him where we essentially had him quit claimed onto title and we waived the requirement for him to be on title for 6 months because we can prove he'd been living there and we can prove he'd been making the mortgage payments. So really, it was his house, right? His and his mom's together. So we had them both retain title moving forward, but he was the only one on our loan, which typically is, a no-go once you quit claim somebody on with such a short amount of time on title. Can use market rents on a departing primary, even without investor experience. So a lot of times, you have somebody that buys, their second home, not a second home, but they're a new primary, and they are retaining their old primary as a rental. Fannie Freddie's going to make you go get a lease. We are not. We're going to say, hey, we're going to look at market rents here, and we're going to qualify them using those market rents towards their DTI calculation. And then more aggressive timelines on a lot of different stuff. These are just a couple examples, but have a guy that sells his business, he's unemployed, he's only been receiving payments on the note, that he essentially financed for his business for a couple months, 2-3 months, and Fannie Freddie's going to make you have a year. Excluding co-signed debts, Fannie Freddie's going to make you have a year. We can do it with 3 months. Part-time income, I think you need 2 years, Fannie Freddie, or at least a year. We're going to do it 6 months. And then same thing, interest dividend income. So just more aggressive timelines. We need, a lot less time of them receiving that type of income for us to be able to use it.
Yeah, and that kind of goes along with the less than 1 year self-employed sort of thing. We're not going to require as much seasoning for income as conventional is. Yeah.
Oh, and then one more bullet popped up down here too. U.S. citizens living abroad but buying either second homes or non-owner in the U.S. So Weston, I think, is closing one like this. I closed one like this earlier this year. For me, it was a couple living in Hong Kong. They filed U.S. taxes and claimed their income, so they could go full doc. But because they were buying an investment property in the U.S. and their current address was overseas, that triggered a manual underwrite. We couldn't do it because it was non-owner, so we were able to swoop in and take care of it for them.
Yep.
Oops.
So
I'm too fast.
Yeah, so 5 to 10 units. I imagine we're probably going to have a webinar all on this in the future, but 5 to 10 units. So recently it was 5 to 8, and then up until about a couple months ago it was 5 to 8, but recently we moved into the 5 to 10 space. And I'd say probably the key thing, the reason that we get a lot of requests for 5 to 10 units is because our pricing is industry leading, at least for a 30-year fixed. You're not going to be able to find a 30-year fixed loan for as cheap as we're able to offer it. But then on top of that too, the service that we offer is same service that you've always experienced from LendSure. But there are a few caveats with 5 to 10 units that I think are important to point out. And the big one is just making sure that the collateral, that our property is good. The ones that I'm doing right now in Alaska, it's 2 cash out refis, and the properties are carbon copies of 3 additional properties that are next to each other. Really the biggest thing that we do with our pre-approval process for the 5 to 10 units is make sure that this is a property that is that makes sense for the area that it's in. Even if, for example, let's say it's legal non-conforming because it was built in 1910 as a triplex, but now the area is zoned for SFRs. We've been able to do that given that we can get a rebuild letter. The biggest the biggest hurdle for 5 to 10 units is just making sure that our property is good, because as far as cash flow is concerned, our DSCR, for a traditional DSCR property, we would want it to be at 1, or sometimes we can even do negative or no ratio financing. But for 5 to 10 units, we want to make sure that the property cash flows well, which in my experience has almost never been an issue, given that you have 8 to 10 units generating income. So 1.1 for DSCR, 75 is the max LTV we do for purchase, 70 for rate and term, 65 for cash out refi. No first-time investors. As Tanner mentioned before, it is possible to get an exception for that if the borrowers can put in 40 to 50% down, right? If they're going to make a purchase on a 8 unit, but they've never had an investment property before, we're not going to give them 75 LTV. There's a good chance we still do the loan, but they're just going to have to come in with more income. Loan sizes up to 2 million, we can go higher with exceptions if it's typical for the area. If again, the borrower has good FICO, if our LTVs are low. As far as 5 to 10 units are concerned, you know, we're doing a lot of the vetting up front so that, you know, you don't have to worry about fallouts with the property or with rents and stuff like that.
We're running low on time here. I'll just bring up a quick example and then try to kind of scoot through the rest of this presentation kind of quick. Minimum FICO on this program is actually 680 now, and I'm doing a 60 LTV cash out refi to 2.2 million on the loan amount. So we're granting an exception on FICO. They actually have a 660 FICO, which is below the 680 minimum. And we're granting an exception on loan size to 2.2, with our compensating factor being a 5% LTV cut on the max cash out LTV, and a borrower whose credit report really should be above 660 when you look at why it's at 660. So, you know, again, exceptions possible, and there's an example of one that we're currently doing. I'll talk quickly about new build condos and condotels. So condotels, you know, our typical guidelines are here. You know, more a condotel looks like a hotel room, the more difficult it's going to be to get done. The square footage and how complete of a kitchen you have will very heavily impact what LTV we're going to do and what kind of terms we're going to offer. So, you know, when we're talking about like 310 square foot condotels, if we're going to do it, it's going to be at a 50 LTV, right? We're talking about 600 plus and, you know, good kitchen, et cetera, then we're at 75. So that plays a huge role in what we're willing to do. And then new build condotels is actually, you know, another one that's an exception, another one that we do very case by case. But, you know, you look at certain projects like the Pendry in Park City. You look at Black Desert in St. George, Utah. You look at some stuff on the East Coast that we've done in, you know, new build condotels. We are willing to be the first lender in some of these cases, meaning, you know, we're the first ones to close loans, but it's going to be at a reduced LTV, and it's going to be with a really strong borrower. You know, we do want cash closings so that we have comps, but you know, the ability to be the first lender closing condotels in a newly built condotel project is something that is unique to LendSure. And then stacking.
Yeah, so stacking is awesome. Majority of my loan officers prefer to stack because essentially what it allows your borrowers to do is decrease their closing costs. So in the scenario when you have a rate and term refi or a cash out refi, all the closing costs are eaten up by the cash out, or we just increase the loan amount for a rate and term refi so that the closing cost, the cash to close, is basically taken up by the loan amount. So we have the ability to do that for purchase transactions as well. For those of you who do VA loans, it's similar to financing the VA funding fee, right? Where the idea is we can finance your borrower paid compensation and potential rate buy down into the loan amount, so increasing the LTV without increasing the rate. So all it does is it increases the loan amount, but it decreases the borrower's cash to close. And we have an example here. If you go to the next slide, that'll kind of, Tanner put this up. He can kind of walk you through this example real quick.
Yeah, so just using easy numbers, let's say you have $1 million purchase and you're putting 50% down, and you as a loan officer are going to charge 2 points in borrower paid comp. So let's say you reach out to LendSure, you get our pricing, it's 8%, and some competitor of ours is quoting you 7.5. Your initial knee-jerk reaction might be, well, why would I go with LendSure? Their pricing is worse. I'm just going to quote what the competitor has. Well, let's look at what we can do to structure this to make more sense for the borrower. So if we introduce 2 discount points here, we can buy our rate down, let's say, to 7%. Now, I know the competitor can buy their rate down too, but just for now, let's proceed on and we'll circle back to that. So the down payment is going to be the same in both cases. The borrower's putting $500K down, but we're actually going to give them a $520,000 loan. That's because we're financing the 4 points, both the borrower paid comp points as well as the discount. So that 4 points is being pushed into the loan amount, meaning they have a $520,000 loan with us. But because their rate is lower, their payment is actually going to be lower. Their cash to close is going to be lower because with the competitor, they still got to pay the BPC out of pocket. And then the total interest over the life of the loan is a lot lower. So if we circle back and go to the competitor and say, well, they can buy the rate down too, sure they can, but now your cash to close is getting even worse. So they may not have the 510,000 to come in, let alone 515 or 520. They're going to say that doesn't work for me. That doesn't make sense. I'm putting 50% down already, and now you're wanting me to put even more down. So when you look at and compare and contrast these two options, you say, okay, Mr. Borrower, here's your two options. I got one with a 7% rate and a better monthly payment and a better cash to close in exchange for a slightly higher loan size. Or I got one with a lower loan size, but a worse rate and a worse payment and a worse cash to close. How does that make any sense for the borrower? And which one are they going to pick, right? And keep in mind, this is, in a quote unquote worst case scenario. This is with our rate being 0.5% worse, let alone if we were to price match or, do something where, we're a lot closer, maybe even beating them, right? Let's say we come in and we say, okay, we're going to do this at a 7.375 at par. Now you add stacking to that and we're completely blowing the competitor out of the competition. It's not even close, right? So, even in this quote unquote worst case scenario, we're presenting terms that are more attractive to the borrower at the end of the day than what, the competitor is offering. So that's stacking in a nutshell. Is you're saying, hey, what are your final terms? What's your final offer? Putting some of these closing costs into the loan amount, buying the rate down, and getting better final terms for the borrower that they actually care about, because they care way more about rate, payment, and cash close than they do about the loan size.
Okay. And before we move on to the next section, what is the minimum loan amount for 5 to 10 units? Joe wants to know.
It's 400,000, isn't it?
Yeah, 400,000. We've gotten exceptions to go a little bit lower, but 400,000 generally is what we're at.
Yep.
Okay.
And then our very last slide. Thank you guys for staying with us for the full hour. But in many ways, I think the most important slide. A lot of the scenarios you get are going to be pretty straightforward scenarios: bank statements, DSCR, etc. So we talked a lot about the niche stuff today, and that stuff, more or less has to come to us if we're the only lender that's going to do it. But what gives you any confidence that we're going to be able to close the deal? What gives you confidence in wanting to use us for all of your non-QM, not just the unique stuff? Well, for one, our account executives all have a very strong credit background. So, we are very, very intentional about making sure that the person that you're talking to is going to bring value, is going to know what they're talking about, is going to be a non-QM expert so that you don't have to. So, with a lot of our competitors, you may be better served using the pricing engine or looking at their guidelines or whatever. I can tell you beyond a shadow of a doubt, with us, it's better to call your account executive. They are going to know how to help you way more than any other competitors' account executives will. Common sense lending, exceptions, right? We talked about that pretty much throughout the whole presentation, so I won't hit on it again. Really what I want to talk mostly about is this extensive pre-approval process, because when we're granting so many exceptions, very often we get the question of like, well, I don't want to risk it. I don't want to, rug pull my borrower and get halfway downstream and then things fall apart, right? And so we're very intentional about making sure that doesn't happen. Within the first 48 to 72 hours in our pre-approval, we actually underwrite the loan and put it in front of senior management for a true loan decision. So the person who is deciding the loans up front that have exceptions is like the boss's boss of the underwriter that eventually gets it, right? They're 2 pay grades higher. And in some cases, the loan even escalates up to our president, who is decisioning deals every single day, prior to an LE even going out. We're making sure that we can do the deal. So, that level of approval and having someone that senior reviewing, these deals up front is a huge, huge deal when it comes to your confidence level and what you're telling your agents, and you being willing to broker loans to us that have hair on them and are quite frankly tough deals, is us being very thorough about vetting them up front. So that's far different than a lot of what the rest of the industry does. It's very unique to us, and you know, I think it deserves a huge call out from me. So that's why I went into it.
And I suggest you guys, the proof is in the pudding. I suggest you guys look us up, look at the reviews that we're getting every week. We've got a 4.8, 4.9 on Google reviews because brokers see how we actively communicate and we solve problems, and we end up with rabid fans because of what our account executives are able to do for you and for your clients. So take a look at what people are saying about LendSure. Now, before we go into our Q&A, a couple of things I wanted to go over with you is these private label resources. You're going to get a link to this in your email, and this contains flyers and emails and banners and all sorts of great stuff that you can use to personalize. You can add your logo in it, and you can start marketing this to your partners right away. And I know, and we do have a few very detailed questions that I will get to in a minute, I promise. But before that, I want to introduce a partner that we have it's Helport. It's an AI partner that we have, and there he's going to. This is Henry. Henry, if you could put your camera on, please. I'm going to have him demo this great AI program that we have that's offered to LendSure brokers for free. That's right, for free. So Henry, I'm going to make you the presenter. So if you could go ahead and share that demo.
And thank you guys. I appreciate the time and appreciate you having me on. So just a quick intro of myself. I'm the director of sales at Helport AI, and a big shout out to our partners at LendSure. We're excited to share what we have today. You know, I spent the last 10 years, just to give you guys a little bit of background, I spent the last 10 years as a top producing loan officer in the Texas and Michigan markets. So that's why we built what we built today for you guys, you know, a loan officer Helport assistant, something that is an end-to-end tool solution that really elevates your game. It not only handles your post-call work, it gives you real-time guidance and also takes actionable insights to help you with your overall workflow. So we're just gonna jump right into a live demo, and we'll show you exactly how it works. Rose is gonna be my client on the other end. I'll be the loan officer, but we wanna show you guys the tool live. So Rose, are you ready?
I am ready.
All right, awesome. So, hi, this is Henry with LendSure Mortgage. I understand you're exploring financing options. Can you tell me a little bit more about the property you're looking to buy?
Yeah, hi, this is Rose. I'm interested in buying a condo in Hawaii as a vacation home, and I just want to explore some options. Do you guys have any loan recommendations?
Yes, we do. So we, you know, have a couple different options, but I'm going to go ahead and ask you some qualifying questions to narrow down your options. What price range were you thinking?
I'm thinking about 800,000, but I can put 20% down.
Got it. Okay, awesome. Do you rent or own?
I rent.
Perfect. And are you self-employed or W-2?
I just quit from my last full-time job with Apple and started an LLC 10 months ago.
Got it. Got it.
Oh, a quick question. How long does it take to get approved?
Yeah, pre-approvals can take as little as 1 to 2 hours once we have your documents, so super quick. Full approvals take as quick as 24 to 48 hours, so we'll get results really quickly.
Sounds good.
Awesome. And just a couple other questions. What's your average monthly income?
About 10,000.
Okay, great. And what ongoing business expenses or business loan payments does you and your company handle each month?
My business lease and utilities around 1,200.
Okay, great. And then how about like monthly liabilities, like personal liabilities, mortgage payments, student loans, car leases?
I've got student loans and a car lease around 700 a month.
Okay, awesome. And your credit score, just really quickly?
775.
Perfect. So you have some great, it's a great profile. You know, you have great credit. However, you know, most lenders, especially with under 2 years of self-employment, they have restrictions. The good news is that our partners over at LendSure, they have a product that offers under 2 years self-employment so that we can, you know, get you into the right program and make sure you qualify so you don't have to wait to purchase that next home.
LendSure, aren't they non-QM? I heard that non-QM has generally really high rates. I don't know about that.
Yeah, so rates can be a little higher, but rates are just a number, right? So, you know, LendSure actually does a lot of loans that traditional lenders can't. So instead of waiting that 2 years for self-employment, LendSure can get you approved and get you into that home today. And they come up with a lot of unique income situations, and we run into all these all the time. And with your situation, I think it's definitely worth it and makes a lot of sense. And many clients find a lot of flexibility, and the rates end up, making sense to them at the end of the day.
Okay. What documents would I need to provide for the loan application?
Of course. So what we're going to do is I'm going to send you an email with the list of documents that we need. And what you'll do is we'll work on the pre-qualification today as soon as you are able to send over those documents. How does that sound?
All right, that sounds good.
All right, perfect. So just a quick recap here. Thank you, Rose, for that. So not only are you getting the real-time guidance, which you'll see on the right side here, right? As you're having the conversation, with unique scenarios like under 2-year self-employment, and just, situations that we don't normally run into, we normally have to call our account executive, at LendSure, or just tell the client, I'm not sure, I have to call you back. Now you're able to get that guidance in real time, and you're able to get, if you're a newer loan officer and you have questions along the way, it's like a mortgage coach right there on the phone with you, right? And it gives you guidance as you're going through the conversation. So you're getting real-time guidance. You get product recommendation as well, as you see, through the, you'll see on the right side here, product recommendation for the loan. You'll get a summary of the conversation in detail. You get a follow-up email that you can send directly to the client. So basically, we are handling all the post-call work and even on-call work that you would have to do, like taking notes or giving you any of that guidance. And then just to highlight really quickly, the call scoring feature. So whether you're an individual LO or you're a team leader on a team as well, being able to get that call scoring and getting a score on every single call with improvement tips and call feedback is one of the greatest features that we see with a number of our clients today. And a lot of clients love this, especially when they're on bigger teams. It's a little competition, but also a lot of accountability as well. And then just the last thing I wanted to point out, so end-to-end process that we talked about, the email that we get to send. I don't know if this is showing. Okay.
Yeah, I can see your screen.
Okay, perfect. So we talked about end-to-end process. So you don't have to worry about taking another note, filling out another field in your LOS system. What we do is we provide you a MISMO 3.4 file at the bottom of this screen in your email. So you'll get the full follow-up summary, the action items, the email to the client. But also you can take this file, you can download the file, and you can upload it straight to your LOS, and it will fill out every field as discussed with the client. So it handles all your post-call work. We call it end-to-end process. We know how much manual work it is for a loan officer to not only talk to clients, but to handle all that back-end work. And our job is to get you guys to close a lot more and do a lot less work. So just a quick couple call to action items on our end. We're very active on social media, so please feel free to check us out on social media. Rose, do you mind just actually, I'm gonna stop sharing my screen. Do you mind? Oh, perfect. So check us out on our landing page. We are gonna send you, you can actually scan the QR code here to go to our landing page. And Rose is gonna, our kind of details of how to sign up are going to be on the platform or on the email after this call. But we want to let you know that this is exclusive for all of LendSure, and it's free for anyone that's signed up with LendSure. So if you're not signed up with LendSure, you have to do that right when you get off the call. But we appreciate the time. My contact information will be in that email as well. We offer a number of products outside of just the assistant that helps with prospecting, and just the whole overall workflow of the loan officer. So we'd love to speak with you more after the call, and thank you guys again for the time.
All right, thank you so much for joining us today. And with that, now normally if you guys have been on these webinars before, I usually say, if somebody asks some detailed scenario questions, I usually say, hey, I want you guys to have the most complete information possible, so I'm going to have an AE reach out to you to answer that question. But since we are talking about niches today, I thought it would be fun to kind of throw a couple curveballs at you guys and see what you think. All right. So Simon, New groundbreaking new condo, Miami Beach, Sunny Isles, etc. construction loans to foreigners with minimum 25% deposit. What do you guys think?
So you're saying it's a new condo project in Miami?
Yes. And a foreign national and 25% down.
Yeah. So I mean, foreign national 25% down is something we do. We can do it either as a DSCR loan or a second home, documenting income. Doing foreign national loans as second homes is somewhat unique to us, not completely, but definitely not run of the mill. I think the biggest questions I would have on that particular scenario would be surrounding the project itself and how new are we talking? Are we like the first lender in? Are there other closings right now? Because if it's so new that it's still non-warrantable and it's still very few lenders involved, we would probably cut LTV on something like that. But if it's just newer, but at this point it's warrantable and there's Fannie Freddie closings and you're just asking about the difficulty of the deal, so to speak, is the foreign national piece of it, then certainly 25% down is in the wheelhouse.
Hey Simon, I see you have a question about custom loaning. Could you do me a favor and rephrase that? I want to get that answered for you. Here's another one. New York, Rockland County, purchase land and ground up construction, price from 2.8 mil to 5 mil, 35% down, and finance land and draws for being completed with consolidated and co-signed 30-year mortgage.
Yeah, so ground up construction is something that we do. It's kind of falls under the umbrella of our fix and flip team. So whether it's a true fix and flip or a fix and hold or ground up construction, that's all within the realm of possibility with us. We are only doing those kinds of loans for business purpose, so not anything owner occupied. But that program itself has its own dedicated team that is specifically built around being subject matter experts in that program. So I can certainly get you connected with that team to go over your specific scenario on if it's going to make sense. I can tell you that one thing for sure they're going to ask about is experience level. So if it's a flipper, how many flips have you done? If it's a ground up construction, how many builds have you done? What's the permitting situation look like? All that. So skin in the game will be a point of emphasis. How much money is our borrower actually putting in here, as well as the viability of the project itself. Like, we don't look at any income docs. It's not like DSCR. There's no like rental income. It's really, we're just looking at the overall economics of the transaction and is the value once it's all said and done going to be such that the cost of the project made sense and everybody involved made money.
All right. For self-employed, 12 years cybersecurity software, non-permanent, 1 year, has an office in LA, I don't know if that's Louisiana or Los Angeles, since May 2023 for support only. So the office is for support staff. Do you allow foreign income using Australian dollars?
Interesting. So you have somebody who's been in this field for, I think you said 12 years.
12 years cybersecurity.
Yeah, and they've only opened up an office in either Los Angeles or Louisiana.
Since 2023.
Yeah, May of 23. And it's foreign income. So they should be if they're living here in the US, they should be a non-permanent resident alien at this point, and they should have a visa. So just like we discussed earlier on the call, that visa type needs to be within our guidelines. They should also have filed US taxes starting when they got that visa. So if they got that back in 23 when they first opened this office here in the US, then we should have 24 taxes claiming that foreign income. That is something that a lot of people neglect doing, which is a problem, but it's something they're obligated to do. You don't pay the same level of taxes on foreign income that you do US income, so it's not in the normal tax brackets, but there is a small amount of taxes that you do pay on foreign income when you claim it on your US taxes, and that's probably what we would have to do. unless, you know, we could look at something like, oh, you know, all the income from this US location runs through a US bank account and a US entity, and so we can look at like a bank statement loan maybe. But if it's true, you know, foreign income, it needs to be claimed on US taxes.
Okay, and I've got a couple of different questions about how they get that the AI tool. Look for the email from me, Rose Waldy, in about an hour. Not only is it going to have that unique link that you're going to click on, because that's going to give you the tool for free, but I've also included instructions, step-by-step instructions on how to get that tool for free. And then Simon says, certain purchases, like individuals that had a lot of write-off with excellent credit, good income, but low cash flow. Sounds to me like a bank statement program.
Yeah, it does to me too. So there's a bunch of reasons that we might not be able to use taxes. A lot of write-offs is a very common one. You know, stuff like, you know, they let's say it's a cash business. So let's say it's like used car sales, right? And so someone will go to these trade shows or, you know, go to certain areas and do certain things where there's a lot of business being conducted, a lot of transactions happening in cash, and they are not depositing that cash to their bank account, you know, in between transactions. Like I sold a car, I got cash from it, and then I went and deposited it to my bank account, and then I pulled it right back out so I could go buy a new car with it to flip that car and sell it, right? Obviously, a borrower is not going to do that. They're just going to transact in cash for the day or for the week or whatever, and then, you know, maybe go deposit it to their bank account, maybe not. So situations like that, we can look at a P&L loan. You know, if they have a CPA that's done their taxes for the last couple of years, we actually just closed a P&L loan last month. It was a fallout loan. We closed it in 7 TRID days. It was owner occupied. So it came in on like a Monday and we closed it on the following Tuesday, because Sunday doesn't count as, you know, a TRID day. So, you know, hopefully that alone speaks to our processes a little bit and, you know, what we're able to do on the service side of things. But P&L loan might make sense for a borrower like that, but certainly what we'd look at first is a bank statement loan.
All right, fantastic. And with that, I want to say thank you so much to everybody for joining us today. Don't forget to look for that email from me, Rose Waldy. It's going to have all those great resources for you. Tanner, any parting words?
No, just, you know, I appreciate you guys that hung on till the end here. It's been a long one, but I would tell you, number one thing is call your account executive. I cannot stress enough how important that is, because they're going to be able to guide you, and you know, you can lean on them and their, you know, subject matter expertise. We're very much not a lender where it's just like we're going to throw the guidelines at you and make you figure it out. You know, we want to partner with you, right? And that goes all the way as far as even educating your agents, right? And doing a presentation where, you know, maybe in person, maybe over Zoom, but you invite your top 3, 4, 5 partners and say, hey, come learn about bridge loans, come learn about, you know, fix and flip, you know, all these different things.
Okay, and Simon says he's got some loans that might fit right in, so send them over, Simon. Go ahead. If you don't know who your account executive is, just simply click reply on the email from me and I'll connect you right away. Weston, any final words?
Nothing to add.
All right, thank you so much, everyone. Have a good one.